G'day everyone, welcome back to Pete's Investing and Trading channel. Today we are trading the CCI14 period strategy with the average down approach, and we're comparing a 5% gain and a 5% average down decline. That's the program we've been using in our recent videos. Comparing that against a gain where we go for a higher gain using the same logic otherwise. And we want to see the results and which strategy is more efficient to trade. Given the overnight price spike of Twitter, after Elon Musk announced his buy of around 9% of the Twitter stock, we'll quickly discuss should we trade this type of stock. And if you do, what to look out for. Remember, we're not offering financial advice, but rather it's an educational series to help you make better trading decisions. I've had to demonstrate the entry and exit strategy with two scenarios. The first scenario is where we enter the trade when the commodity channel index 14 period crosses over the zero line. We exit the trade when the closing price gains at least 5% gain, and we average down when the close of the day declines by at least 5% and the CCI14 breaks above the zero line. We then buy double the quantity of shares from the previous trade we made. The second scenario is exactly the same as the first. The average down in criteria is the first, except we aim for a higher percentage gain. Since the Twitter price spiked by around 27% overnight, then let's see the result of aiming for a higher exit. So let's first of all jump to our programs. What I've got here, the bottom, the blue chart here demonstrates the profitability chart. This is the price chart for Twitter on a daily time frame. And this is our original baseline program we use on a 5% gain and a 5% decline. This top program uses exactly the same logic at the moment, so it's delivering the same results. So they're both delivering 17,886 to date, with the price closing at that point overnight. Now you'll notice with our program that the position closed out before this price spike at that point there being gained 5% gain. So in our program, we would have got out of the trade before the price spike. So just keep that in mind on the total revenue raised in our program. So let's change this top program from a 5% gain to a 10% gain and see what the result looks like. So I'll make that a 10% gain. Now you'll notice the price, red arrow indicates where we bought the last average down approach, and we're still in a trade on the red, or the new strategy. Now you'll notice we closed out our program at 5% gain there, but the new 10% gain program is still in a trade. Now a couple of things to note here. Again, we've generated 17,886 in our program, and the new program is now generated 62,304. So it's a massive jump from our program. But a couple of things to keep in mind. Number one, we're still in a trade. So if the price opened up and closed much lower than that tomorrow, which at this point I doubt that will close much lower than where it is at the moment. You might lose, you probably will get a few sellers. But let's see what happens tomorrow. But let's go more importantly back in history. You'll notice back here during this trade, we entered 1, 2, 3, 4, 5 average down entries. We closed out our trade there for profitability at 46.72. Okay, so we opened up the trades initially there, and we averaged down in the price chart in those areas before closing out at that point there. The new program with a 10% gain was still in a trade, and it closed out a bit later, after averaging down 1, 2, 3, 4, 5, 6 average downs. This one closed out at 46.72, we said. This one closed out at 13.136. So a lot more at this point. But notice what it's doing. You're in the trade longer. Likewise, this one closed out about the same. This one you can see there, closed out in a shorter period with a 5% gain. This one lasted longer. Now you might say that's fine. I'm happy to stay in the trade for an extra 1 or 2 months, as in this example. Now let's change it again from 10% to 15%. Now notice, we don't want to get too greedy because a couple of things happen. So again, this bottom program won't change, the top one here. Now, one thing to note, we're still in a trade, and it's still at 66,646 versus ours of 17,886. You might still say, well, Pete, we're still in a trade, why not just stay in it? But again, a couple of things to notice in this one. You are extending your hold for each of these, because if you don't hit the 10% gain, you won't get out of the trade. Now I will make one more change from 15% to 20%. Notice from 66,000, we've dropped down to 46. Now why is that? The reason is we haven't averaged down because we haven't hit our minimum gains yet. So we're still in a trade and have dropped our profitability because we got in a trade later. And these ones here, you'll notice this one really extended out. They've all extended out a lot longer. Okay. So yes, it does reap higher rewards if you raise the get out price from 5% to 10, 15 or 20%, but you've got to be prepared to hold on longer. Let's go to one of our common stocks with a blue chip stock, the Commonwealth Bank, for example, at 20%. You can see there very clearly you're in the trades longer. Okay, so that's quite a few years you're holding on to those stocks, that stock. Now, yes, you got 14,000 there as per original in this particular program we're running versus 32, so that's double the price, double the returns, I should say. But again, you've got to be prepared to hold on to the stock for a number of years. So we opened up back here around 2015, and we closed out here in 2020. So about 5 years you're holding on to that. Whereas in this scenario, getting in and out more frequently during that 5-6 year period. So it really comes down to you if you want to hold on for longer periods and try and aim for those higher gains versus getting in and out to some cash flow. Let's go to one other stock, Telefonica, a European stock. You'll notice here the share price has been going down. Again, this is holding on quite substantially for a few years with our current program, but also similarly with the 20% gain. I suppose what I'm trying to say is don't get too greedy. If you can afford to get out, you want the cash flow. If you're happy to hold on, by all means, hold on to that. So let's go back to our investment rules, trading rules. Buy proven blue chip stocks only, avoid speculative stocks. This ensures probability of the shares of the company you're buying has had a good track record and more likely potential for future growth. But importantly, from today's Twitter example, we aren't beholden to very radical price hikes, or even more importantly to be aware of, we're not beholden to any slumps in the share price. Buy stocks which pay dividends. Do a quick search of the stock before buying to ensure it recently paid a dividend or about to. This is a good indicator that the company has future potential of growth. The company recently, that is 6 to 12 months ago, stopped paying dividends. It may be a sign that growth potential may be challenged for whatever reasons. Don't short positions, go long only. And again, if you're trading CFDs or other leveraged instruments and you go short, you'll be paying those dividends, if there are dividends paid, to the people that are going long in those same positions. Do not trade on news. Price has already been factored in the share price. So from today's Twitter price, if you want to go buy tomorrow, there's a good chance it may actually decline, but you're basically gambling. So again, it's a speculative stock. It doesn't pay a dividend. It's a bit of a gamble. It may continue to rise. It may not. Again, I'm not offering you any advice on to which way to go. I'm just simply bringing it to your awareness that you should be very careful how you trade these types of stocks. They're very speculative. Again, don't forget to review our playlist. Click the like button, the notification bell, and we'll see you in the next video.